we understand multifamily. We understand these cycles. We understand that this is not permanent. You have to think long term. We also know how, as I mentioned before, how to figure out what is forced appreciation, what is organic appreciation, and buy based on metrics of forced appreciation. Look at the market, see what the rents are for a particular unit, and if you increase value of that particular unit, how much more rents you can get. Those are some of the important factors to consider when you're buying an asset, regardless of the time, but specifically when there's dips, you can gain a tremendous advantage and take advantage of that situation and buy at a very low.
Welcome, everybody, to today's episode. When most people think about real estate investing, they imagine snapping up properties and watching the value skyrocket. But what if I told you that sometimes having the value of your rental property decrease can actually be a good thing? In today's episode, we are joined by Ravi Gupta, co-founder and COO of Viking Capital. So welcome, Ravi.
Thank you for having me.
Awesome. Today, we're going to be diving into the upside of the downside when it comes to multifamily values. Whenever I say that, I think of Stranger Things when they're exploring the upside down. So
Yes.
I'm excited to dive into it. So Ravi, have you ever thought about or considered how economic downturns could actually present a buying opportunity for multifamily? Because most people think of, hey, buy low, sell high. The market's always going to rise, right? It's always going to go up and to the right. But what kind of various economic factors can affect property values? And then how can that kind of serve as an opportunity?
Yeah. And you're absolutely right, Nathan. I remember when my father and I were trying to flip new homes back in, 2000, I think it was 2006 or 2007. So what we do is we'd buy a townhome. There was a lot of organic appreciation around that time. And then we'd flip it for like 30 grand. And we did that once or twice and we made money. So we're like, oh, let's go bigger. So we ended up buying a single family home for $875,000. And it seemed very expensive at the time, but we were thinking, hey, look, the way the economy is going, the way prices are going, we're going to be able to flip this and make like a cool 50K. We bought it right at the peak of the market. And there was a tremendous downturn at the time. This was like, 2008, 2009 correction. The property, in fact, dropped 300,000 in value, if not more than that, maybe a couple years later. So we ended up holding it for 10 years before we saw that recover. So buying just based on organic appreciation and, hoping that things were gonna go up and improve is not a way to invest. There's so many factors to look at when you're looking for investment. Now, you frame this as the upside of the downside. The upside there for somebody who is coming into the market, and in this particular example, buying a new home is, hey, I can scoop these up for very cheap. And there were some people that just walked away. They're like, look, I'm losing way too much money. Like, I'm way underwater on this. I'm just going to walk away. Here's my, whatever they put down, 100,000 down, let the bank take it, and I'm walking out. And then other people come in and scoop up deals. And that's the upside. You can find some great values. So that's something to think about. The cost basis drops tremendously. And we're seeing that already in the market. We're seeing the cost basis drop a lot in some of these investment properties. And there's a tremendous amount of upside that we're seeing because of forced appreciation. So that's the other thing to consider. There's just standard appreciation, how, the market goes up over time. There's ups and downs, but it'll go up over time. That's just standard appreciation. Forced appreciation is when you're renovating units, you're renovating the asset, you're improving it, you're increasing rents, and then it's worth more. So multifamily is priced differently than single family homes in that way, for example, because single family homes are comps. Like every home next to it is a potential comp. In a multifamily asset or apartment complex, you don't have those comps. You certainly have other assets around it where you can gauge the price of it, but the price of that particular asset is based on the operating income, the income that it produces. So if you can increase the revenue, you're increasing the value of that asset. So you consider that. You consider interest rates. You consider inflation. You consider job growth. I mean, these are all factors to consider when you are purchasing an asset.
Yeah. And that's the thing. Most people don't realize that real estate is very cyclical, and most markets are pretty cyclical, right? If you ask the average person off the street, hey, what real estate market are we in? They'll probably have no idea, right? And even some investors probably have no idea, right? Like some investors think that the market is kind of like a chicken with its head cut off, right? It's going different directions and no one knows when it's going to go up or when it's going down. But fundamentally, if you understand the kind of the supply and demand dynamics, you can one kind of assess where you are currently based off of the current supply and demand, but you kind of know what's coming down the line based off of the interest rates, based off of new construction, based off of unemployment and the general economy. So that's kind of the next kind of route that I want to take. So how can investors really take advantage of a temporary dip in value that allows them to buy low? And keep in mind, there's different people coming in and exiting the market too, right? There's brand new investors that are just entering the market. There are people that are kind of at the lifetime of their kind of call it investing career and are exiting the market. And there's a whole plethora of people that are kind of in the middle that are buying and selling and kind of picking up assets and disposing of them kind of on a continual basis. So how does following that real estate cycle really provide an opportunity to buy?
Yeah, great question. Something to keep in mind is when the Federal Reserve Bank decoupled the value of the dollar from gold, when it was very closely tied to the value of gold, there was more market stability. When that became decoupled, and it was just the value that the government put on the asset or the money itself, then you could start printing money, right? Then there's no correlation, and that's when the boom bust cycles really started. So we're always going to see these boom bust cycles. That's something to keep in mind. That's going to happen for as long as we can project. And we've seen several of them. In my lifetime, I've seen several of them, and they will continue to happen. So knowing this and knowing that you're going to have a boom bust, take advantage of that situation. Understand that when the market is dipping, this is a temporary dip. This is not a permanent dip. Some people get scared and they go to their corner and really hide because they're like, oh, there's fear out there. People don't know what's going to happen. Things aren't going to recover. I'm just going to wait and hold my money and not do anything with it. You can do that. That's a strategy. But if you understand the asset class that you're investing in, so this is a multifamily podcast. We understand, Viking's a multifamily syndication company. We understand multifamily. We understand these cycles. We understand that this is not permanent. You have to think long-term. We also know how, as I mentioned before, how to figure out what is forced appreciation, what is organic appreciation, and buy based on metrics of forced appreciation. Look at the market, see what the rents are for a particular unit. And if you increase value of that particular unit, how much more rents you can get. Those are some of the important factors to consider when you're buying an asset, regardless of the time, but specifically when there's dips, you can gain a tremendous advantage and take advantage of that situation and buy at a very low cost basis and make improvements and then sell and reap the rewards.
Yep. And one of the ways to do that is to look at kind of the relationship between interest rates and cap rates, right? There isn't kind of a direct correlation, but the idea is that as interest rates rise, it becomes harder to purchase properties. And so properties essentially lose value because the buyers can't afford to pay kind of the same pricing that sellers want to part their assets for. We're seeing a lot of that, bid ask spread is what they call it. But essentially it's the difference between what sellers want to part their assets for and what buyers can afford to pay with the current interest rates. And so if you take a look at the federal funds rate, that's what sets kind of most of the interest rates. Every time that the Fed has raised rates, right, they've gone to a certain point, it's caused a recession or recession-like environment, and they started to reduce rates. So, if you're buying as interest rates are rising, and let's say you have fixed debt, technically the value of your property is you're losing value because as interest rates rise, buyers can't afford to pay the same that they did, 6 months ago or 12 months ago. But if you know that real estate is kind of a cyclical market or it's in kind of a cyclical nature, you'll know that eventually rates will come down in the future, which will then, compress pricing and kind of bring your property back in more favorable light because buyers can afford to pay given kind of the debt market that they can use to leverage those properties. So let's kind of compare and contrast, Ravi, because you talked on a little bit about something that kind of related to stocks. So what are the ways that, a drop in property value is a little bit different than kind of a stock losing value?
Yeah. So, when we all invest in stocks at some point in our lives, and oftentimes when you invest in the stock, you may not know a lot about the company. You may know little of it. Maybe you're investing through your financial planner and they're picking for you. But the stock can go up and down, but once it drops, you want to hold on to it and you don't want to sell because you're selling at a loss, and you don't know how long it's going to take to get to recover to where it was before. And maybe it does. Maybe you get some profits, maybe you don't. It's hard to tell in a lot of these stocks because you don't know the fundamentals of the company that well. The different thing about an asset, real estate asset, is number one, you can kick the tires, you can see the asset, you know what you're investing in. Number two, there's the same dips, like similar to a stock, you're still going to get some of those dips, but because of forced appreciation, because you can improve that asset, you can understand how the asset will recover out of that dip. And I'll give you a particular example. There's an asset that we have in particular that has in a market, but at the time of this recording, November 2023, we are in that dip cycle. And we see that it has decreased in value because the cap rates have gone up. But if we continue our business plan and improve the asset as we are going to, even if the market stayed the way it was, the way it is currently, in fact, we would still be profitable on exit. And we are very sure of that because we're getting some tremendous rent bumps every time we improve a unit. So there's more security there. There's less volatility. I really feel like you can understand what's happening on the ground level a bit better in the stock market. So those are some of the ways I think about stocks and multifamily assets.
Yep. Yeah, that's a really good point, right? And for most real estate assets, but specifically multifamily, right, you get continued cash flow throughout the whole period. It's not just solely reliant on buying low and selling high. So there's kind of a comparison there between the dividends that you get from a stock and the cash flow that you get from a property. But kind of the key difference there is that dividends aren't necessarily guaranteed, right? Whereas if you have a traditional syndication structure that has a preferred return, like a 6% preferred return or a 7% preferred return on your money, that's the closest thing you can get to almost kind of guaranteed return on your money, right? When you go to sell, you're at least guaranteed the 7% throughout kind of the whole period. So, Ravi, let's pivot a little bit. You talked a little bit about forced appreciation. Can you kind of walk us through how forced appreciation, through renovations can potentially lead to a property loss in value, but result in gains over kind of the long run?
Yeah, sure. So, and that's a great question. When you purchase an asset, and you raise the capital to improve the asset, automatically you're basically at a loss, right? Because you've raised money to purchase, you've raised enough capital to improve the asset. So if you were to sell right then and there, you would be at a loss because of the costs that are associated with closing, there's no value that you've created. But as you implement your business plan over time, you're improving the asset, you're starting to increase the revenue. That's where the gains come in. So what we see as a company is we start the renovation, the business plan day one, and after 12 months, we are starting to see an increase in revenue. We're seeing the results of it. After 18 months, 24 months, we are almost fully implemented in our business plan. And that's when we see the asset, in fact, gaining value. So maybe in 2 years, you could maybe sell for what you purchased it for. But in the past several years, the organic appreciation increase was so much that people are making a ton of money after selling 2 years. But typically that doesn't happen. So maybe after 2 years, there's an equivalent equilibrium between the cost basis and the value of the asset. But then the ensuing years of operating it, the third, the fourth, the fifth year of operating it, cycling through the rent roll, that type of thing, that's when you see the increase in revenue and the increase in value. So that's why typically when we underwrite an asset, we typically look at a 5-year sale, because we need that time to completely reap the benefit of that business plan. So, if you look at a curve in terms of like kind of the purchase price and then the value of the asset, it's sort of like, it's like there's a dip, there's an initial dip, and then it starts going up and up and up. And then year 5, you sell, and that's when you get the profits, and then you reinvest into another one.
Yeah. Especially if you're doing a value add plan, right? Like there's always that fine balance between maintaining occupancy, but also wanting to drive renovations. Because ultimately, right, in an ideal scenario, the renovations are what are driving the premiums, which will then drive your revenue. And if you're optimizing expenses, should drive your net operating income as well, your NOI, right? And again, as Ravi has touched on before, the NOI, or the income that the property produces, that is what is kind of a fundamental factor in the valuation of the property. The other factor is the cap rates, which you don't have as much control over. So might as well take as much control over the income as possible. So, you'll typically see higher vacancy or lower occupancy when you're renovating units, right? Because it takes longer to turn them around. They're off the market for a little bit longer. But the benefit of that is that you're able to capture premiums after those units are renovated, which then drives value. Same thing for bad debt, for example, right? You might be cleaning up the rent roll, you might be getting new tenants in, and that takes time to really kind of cycle through that property, especially because all leases don't end at the exact same time, right? They're spread out throughout the year. So you have to kind of wait for leases to expire before kind of renovating or finding some sort of other creative solution. But you're going to expect kind of less cash flow during those first initial years, knowing that you're kind of baking in the longer term growth via those renovations for when you do go to sell. So, Ravi, a lot of the reasons that investors invest in multifamily or in real estate in general are the tax benefits. Can you walk through the tax benefits like depreciation that would allow investors to offset income when the property values decrease?
Yeah, absolutely. And this is a very important point, and a lot of investors invest in multifamily because of the tax benefits alone. In fact, we've got a sizable portion of our investment pool that really just wants that tax benefit, and that's it. They're like, certainly they'll take the dividends, but that's just icing on the cake. So what happens is you purchase an asset and you do what we call a cost segregation study. What a cost segregation study is taking certain parts of the property, like, for example, the appliances, the HVAC, the water heater, all that kind of stuff, and segregating it out into the amount of years of useful life. So, for example, a appliance may have like a 7-year useful life period, and you could depreciate that those assets over a 7-year time frame. There's something called bonus depreciation, and that, in fact, is slowly being phased out. So bonus depreciation is if you have an asset, which is 5, 7, 15 years, you can depreciate the entire amount of that asset over the course of 1 year. So in the past, last year, for example, we were able to depreciate 100% of those assets year one. So people that invested $100,000, we had one particular investment where you invest $100,000, you can write off $100,000 year one. That's huge. Imagine that. Like, it's like you lost that money. So on paper, not in real life, it's on paper. So you lose $100,000. That loss can offset potential gains you have, in other types of investments. It doesn't have to be real estate in particular. So you're offsetting your gains and you're saving a lot in taxes that way. The bonus depreciation is being phased out. This current year, it's 80%. It's going to drop to 60% next year. It's going to go so on and so forth until it gets down to zero. So, investing this year or next year is beneficial if you're looking for that bonus depreciation. But that's how depreciation can reduce your tax burden and can sort of help your overall position and offset some of the gains.
Yep. And the same is true on the property front too, right? We understand how the counties and the states that our property is located in, we know how those taxes are assessed. And taxes aren't always assessed at 100% of the purchase price. So lowering the property taxes, again, will drive value for the property as well. So there's times where actually a lower tax bill is really, really beneficial to us as property owners, right? Depending on, there's certain states that have assessment cycles. So sometimes they only assess properties every 4 years. So it can be more beneficial to, to purchase a property at the beginning of that cycle. So you have kind of the longest hold period before you get reassessed. But likewise, you always do a tax appeal as well, right? To really appeal those taxes, to drive down the tax value, which again drives down the expense side of things, which then increases value for the property as well. So you kind of use taxes on the property side, but also on the investor side as well. Let's kind of transition, Ravi, to a strategic investment or reinvestment, I should say, right? When selling a devalued property or selling a property that is kind of devaluing can sometimes be optimal for maximizing returns by purchasing a new property with those funds. Can you kind of walk through that strategy and when that might be an optimal choice?
Yeah, Nathan. So that's a great question. That's something that I don't see very often, but some people may want to pursue this type of strategy. And basically what that is when you see the market at a downturn, you realize that your return on equity is dropping steadily over time. And maybe it makes sense to pull that equity out. You pull it out, you wait till the market really dips, and then you reinvest that into another asset that that maybe has also lost a lot of value, but there's an opportunity for you there, and that way you can build that return on equity faster. So it's a strategy that people can use when they're seeing the start of a dip, and they just kind of be like, "Hey, look, I may not be getting the best pricing for this, but I'm seeing this happening. Let me go ahead and sell at whatever price I can get and take that equity and reinvest in something else, many months down the road."
Yep. And that works best if the operator or the deal is kind of under a time constraint too, where they don't have a lot of time to wait, right? Like if the loan's coming due in a year and you see property values decrease, it's probably pretty unlikely that the market's going to take a major swing and swing, directly back up, right? It's a risk that you might want to take, but generally it might make more sense to sell the property, even if you are losing a bit of value, because you don't have the optionality to hold it for a longer hold period.
Yeah. And kind of a rule of thumb that we always use is time will heal all wounds. You just, if you have a property that's dipped in value, it may make sense. You typically makes sense just to hold. And we're seeing that a lot in our portfolio now that the market is shifted. We're realizing that we're going to have to just hold longer. And the longer you hold, and especially if you have a nice business plan in place and it's a value add, the higher the better the property will do, the more it'll appreciate. And as market corrects, you could potentially sell at a more compressed cap rate.
Yep, absolutely. How does diversification mitigate risk if properties lose value? Because we talked about in the past how important diversification is and how not all locations and not all properties are the same. And kind of along that same reasoning, not all values are going to increase and decrease simultaneously. So can you kind of walk us through how diversification might actually, help mitigate risk if a property does kind of decrease or dip in value?
Yeah, I mean, I think we did a whole podcast on diversification, and if you all are interested in diversifying your assets, or you should all be interested in that, please refer to that podcast because there's a lot of great information in there. But just in a nutshell, diversification in general is extremely important. I'll give you an example that we have. We have a particular property that we were only able to get a 2-year term loan on, just given where we were at that particular time, and we're coming up on time to refinance. Everything went very well with that asset. In fact, it's been like blowing out its revenue and hitting its NOI target. But because we have to refinance in this, at this time, the returns aren't going to be as good as we were. It may not be as good as we're hoping. We may hit the numbers, but it may take a little bit longer, and that's fine. Whereas another asset that we were thinking, oh, this one's a decent one. We don't see it really doing We see it like kind of hitting our pro forma and maybe a little bit more if we're lucky, but that's it. It just blew it out of the water. I mean, we were getting these crazy rent bumps, and we got a ton of interest in people wanting to live there. So, if you diversify across investments, even if you think the investment may not be the strongest, but you believe in that sponsor, it's always to your advantage. You don't want to put all your eggs in one basket. You want to diversify across investments, across asset classes, potentially if just to invest diversify across geographic areas. The more diversification you have, the better you can tolerate these swings. For example, if you want to invest some in industrial, or if you did invest in industrial is doing great now. They're not taking these big hits like office and multifamily. So you might have a little bit there, a little bit in office, a little bit multifamily. You might be taking a hit in office, but industrial is making up for that. That's how you mitigate risk.
Yep, absolutely. Yeah, different asset classes are going to have different kind of peaks, and if you look at kind of returns of at least real estate asset classes, they haven't all performed the same throughout history, right? At some point, multifamily has been at the top. Sometimes it's been office, sometimes it's been industrial. And so you want to mitigate, obviously the portfolio and have, adequate reserves to really be able to weather those storms. Because ultimately the value of the property really only matters when you go to refinance a deal or when you go to sell a deal, right? Any other time, it's really the cash flow that is kind of the determining factor. And as you said, Ravi, right? If you're not able to hit your exit projections and you still have optionality where your debt is fixed and it's long term and you're not forced to sell, it can cash flow, and your equity multiple and cash on cash is probably going to be pretty similar to what you projected. It's mainly just the IRR, right? That one specific metric that's going to take a dip. But with that, Ravi, kind of as a final question, as an investor, how can you remain flexible and really kind of adapt to, anticipate or respond to different market fluctuations and market conditions?
Yeah, that's a great question. And what I think it requires is an investor to think long term. If you get too caught up in a particular investment that has lost value, and you're like, oh man, I'm done with this, I'm not going to invest anymore, after this one I'm out, then you have lost opportunity. If you're thinking, okay, this is a long-term strategy I'm employing, I am going to mitigate my risk by investing in multiple different assets. And like if there is a rise, awesome. If there's a fall, that's okay, we can hold. And maybe you may miss out on some distributions. Many distributions, many people pause distributions during these times. But as I mentioned before, as long as you can hold over time, things will steadily improve. And history has shown that real estate has performed very well over the years. Especially when you're able to leverage like you are with the amount of the debt that we get with multifamily and other real estate assets. You're leveraging that debt to make your equity investments even higher. So that is the strategy. That's the mindset to go into. And also the other thing to think about is if you have a sponsor you trust, think of them as a guide, someone to guide you and advocate for you in your types of investments. So if there is an investment that you're not doing well in, ask them about it. Ask them how they're mitigating risk. Ask them how they're working through that asset. And if they have something else that comes up and that looks like a good investment, continue to invest, because it's like dollar cost averaging, right? Mm-hmm. You invest a little bit at a time, and over time it grows tremendously. And that is the mindset to really bring about tremendous financial gains. Because if you're just that one and done type person, it'll be hard to make a lot of gains in the market. There's you have to take risk. Everybody's taking risk. You do the best you can, but you want to have an asymmetric risk reward ratio, and that's what investing in real estate does for you.
Yeah. That commitment for kind of long-term investing, I think, is absolutely key, right? Not every deal is going to be a home run or like a slam dunk, right? A lot of the deals are going to be singles, doubles, triples, and those are great deals, right? But if you're constantly way on the sidelines, waiting for the right deal and waiting for that, exact home run, you're probably going to miss a lot of opportunities. And same thing as like, a Michael Jordan or LeBron James. Imagine if they walked off the court after missing their first shot, right? You're going to want to consistently reinvest, reevaluate, and get better than every investment you do. So, Ravi, I appreciate the kind of candid, open, transparent conversation. I always love, going against the grain and really kind of picking apart these kind of conversations where, people think about real estate and they think about profits and only increase in value, but there's also opportunity when properties decrease in value. So, Ravi, I appreciate your insights. And I'm sure we'll catch you on the next one.
Absolutely. Thanks, Nathan.
Thanks, Ravi. See ya.
If you like this podcast, please hit subscribe or a thumbs up, and we'll see you next time.